Hump Day market update. And we're starting a little bit early. You know, we usually start at 7 o'clock, but what the hell? Because really, quite frankly, nobody watches this live.
Week.
Yeah, it's been a busy week, but nobody's really watching this live.
I mean, my dad's definitely.
Your dad's on, I
waiting
know.
with bated breath.
And this is not necessarily to be a live deal. It's for people to get this information later in the day or tomorrow because it'll be important information. And we're going to talk a lot about what's going on right now in the markets, meaning today, and what we see in the future, meaning near future. We'll talk about the short-term future because, long-term, we don't know. With the second year of a presidential cycle usually not being that great, but we are right now still in the first year of a presidential cycle, and the markets are doing pretty good. So let's talk about.
Not to mention that the markets are a forward-looking indicator, so they're already 6 months ahead of all of us.
Yeah, and we were trading up today, and then the Fed had a meeting,
and then Jerome Powell spoke.
Yeah, but let's let's talk about what the markets did today. If you can see that, I will get the cursor. The Dow Jones down 171 points. That's about 0.3%. The S&P 500 down fractionally 8 points at 63.62, but all near all-time highs. The Nasdaq up 31. That's fractional. Again, it's 0.15%. Let's talk about small caps. We're down a little bit, a little more than 0.5%. Not a lot of action out there, and the market's still pretty boring with the VIX trading at 15. That's the volatility index. So not a lot going on there.
That's the fear barometer.
Exactly. And we were up, a decent amount in the morning, and then
Jerome Powell opened his mouth.
2 o'clock today, he came out, which it was not unexpected.
No.
Nobody expected that he was going to cut interest rates. I think there was hope, but it was, to me, nobody expected that.
The unexpected part of the Fed report today was that we had two people who disagreed with Jerome Powell.
They had two decedents. Am I saying that properly?
No.
Descendant?
No. Descendant is a kid.
Okay. Descendant.
No.
Dissented.
No.
Two dissented.
Yes.
That's correct.
Yes.
Okay.
Dissenters.
Dissenters, but two dissented.
Yes.
See that? We talked about that earlier.
Yes. Now say it 5 times fast.
Two dissented. Two dissented. Two of the Fed governors actually voted to cut rates for 25 basis points. But surprise, surprise, these two were appointed by
the current president.
Yeah. So these.
But so was Jerome Powell.
Yes, Jerome Powell in 2017 was appointed by Donald Trump.
So,
interesting. But although, I got to tell you, Jay Powell's got a spine.
He's a spine of steel.
The pressure he must be under right now, and you know that our president can put pressure on people. And as you can see, what's going on with the tariff and which is in our favor right now.
And the nicknames, too late.
Oh yeah.
Man, yeah. No, he's facing heavy fire.
Yeah, and then here's the other thing: is that before today's meeting, there was a 65% chance that the Fed cut rates in September. That dropped after the meeting to 50% chance the Fed's going to cut rates in September. So now it's a coin toss.
Yeah, but you're saying there's a chance.
There's a chance. And, there will be. We're starting to see things. I mean, the economy's starting to show some cracks in it, a couple things. I mean, GDP came out, which is not bad, but it's...
No, I mean, the economy grew 3% in Q2, which is a lot better than the GDP numbers that we saw for Q1, where the economy contracted by 0.5%. I mean, we did see where businesses, they tried to front run the tariffs by just, bulking up on their inventory, which is the reason why we saw a negative GDP number in Q1.
Right. People are afraid they're going to have to pay huge tariffs, and they just book inventory.
Yeah.
It's all inventory.
Exactly. So we saw that rebound, but I mean, consumer spending was up 1.4%. That's good. We want to make sure that the consumer is still maintaining and staying strong. The consumer is 2/3 of our GDP and what makes up our economy. So we want to make sure that stays intact. And so just because we're now starting to see some of the fracturing of what the tariff tantrum is actually doing to the consumer and the economy, that's why the Fed and Jerome Powell is remaining diligent and sticking to the course of we want to make sure that we know what these tariffs and this situation, this taco trade is actually doing to the everyday person. And the labor force is stayed strong. So
I mean,
that's their mandate.
Ask the people that got laid off at Microsoft, 9,000 of them. I mean, there are tech companies laying off, but that's part of it. They over recruit. They pick up a lot of talent when things are really, really good. And when they see some cloudiness in the future, they say, do we really need this person? And I saw something today that Meta, their AI department has significantly, they are leveraging their AI and actually turning it into profitability right now. So because Meta reported earnings, of course, the parent company of Facebook, and as well as the one Instagram that you're
WhatsApp.
on. WhatsApp. So
we'll
talk about those in a little bit.
Real fast. So I do want to touch on, before we leave, the deep data, the economic numbers, and me nerding out. Core PCE, the personal consumption expenditure that the Fed watches.
Jay Powell watches that one closely. That's one of his biggest indicators.
Yes, and excluding food and energy that nobody uses, that came in at 2.5%, which is really close to the Fed's 2% target.
Yeah.
So that is a good indicator. That's coming in line with where the Fed wants it to be, which is exciting and could lead to the Fed cutting rates.
Look, it seems like everybody wants the Fed to cut rates. Certainly, people in the real estate business. And I was just talking to a
every
home
millennial
builder.
does.
Yeah, of course. And I was just talking to it. But just because the Fed cuts rates doesn't mean mortgage rates are going down. We
Not
saw this.
instantaneously.
No, it takes time. It doesn't happen overnight. Now, what will go down immediately, your credit card rates are going down.
Yes.
Your credit card rates are going down. Your credit lines are going down. And, but so is your savings rate.
Yeah,
so
absolutely.
is your savings rate. That's going down.
What the bank gives you, immediately cut that minute.
So, we get high yield money markets. We use Schwab, and our Schwab money market rate is like 4.1% right now.
Currently, yeah.
Yeah, so it will drop 25 basis points. It will drop 25. When they cut, it's dropping 25 basis points. Yep. So, it certainly hurts the older demographic.
Anyone on a fixed
that
income
lives on savings.
Yeah.
It really does hurt them. I mean, for years, money market rates were crap.
Just 40 years,
I mean, there was nothing. There was no rates there, but now they're finally enjoying them. So it does hurt them. I hate to see that.
Yeah.
So the market is, no surprise, the month of July has been really, really good. But that's been kind of a trend here over the last several years, right, Nick?
Yeah. I mean, July, we have seen an up July, a positive July, as long as nothing absolutely catastrophic happens tomorrow and, we don't shit the bed the last day of July.
Yeah.
This is going to be the 11th straight year of a positive July. What that means seasonally is that, on average, August looks like, on average, again, you're going to be down roughly 0.3%.
August is not going to be great. It usually is not.
We're sliding into like a seasonal slump.
And here's the thing: is
between August and September.
This is a chart here. This is where the market was in April.
Yes,
the S&P 500. The S&P 500 went from 61.47 down to 40. It touched at 48.35. That was a 20% drop.
Yes,
roughly, plus or minus a little bit. But from there, went 48.35, broke all-time highs right here, and now it's near all-time highs. It's at 63.62. So that is a huge gain in a very, very short period of time. It's not coming out of a recession either.
No, this is one of the sharpest non-recession rallies in 20 years. The S&P 500 has surged as much as 32% off of that April low.
So this is my feeling. I am not comfortable taking big bets up here. I am not.
No.
Because a couple of things is that this blue line is the 50-day moving average, and that's what a lot of technicians, which I am, watch. The 50-day moving average at 61.16. That's about 200 and some points away. That's about 3%. So at the very least, the market needs to pull back to the 50-day moving average, at the very least.
Well, it's going to.
It will eventually, and who knows when, but because the 50-day moving average, stocks, indexes will always, now they may not always pull back to the 50-day, but they could trade sideways enough to where they catch up. Because if you look here, I'll show you the history. This is the S&P 500 for the last year or so. It got above the 50-day, pulls back. Rallies up, above the 50-day, pulls back. Rallies up, pulls back. It trades a little bit, little choppiness, gets back going, hits the high from here above the 50-day, hits another high, and then gets pounded in late February, March, and April. So it violated the 50-day moving average, major support, violated the 200-day moving average, major support, and then went just parabolic to the downside. So then we rally. This is an absolute parabolic move. Rally up. We test now the 200-day, which is the red line, while the 50-day changes direction. 50-day is the average price of this index over the last 50 days. So if I put the point right here, that is 57.11. That's the 50-day average, meaning over the last 50 days, you add up all the numbers for the S&P 500, divide by 50, it's 57.11. And that is your short-term trend line. And it shows that when it started turning up, the momentum certainly did it. Then you had a golden cross here where the 50-day goes up, but we're not going to talk about that today. Regardless, stocks, indexes need to pull back to their 50-day moving averages. And right now, we're a little bit in a difficult situation, all right, because we have a ton of profits in clients' accounts for a lot of stocks. And
which is a wonderful
it's a great problem to
be
have.
in, yes.
But what I don't want to do is I'm not sure we're going into a bear market. I think that we're going into just a sideways correction, which you do see, and these sideways
presentation mode for me, please.
Yes, these sideways corrections happen frequently.
Yes.
So and I'll show you real quick because when you
it's to be expected.
It is to be expected. So a 5%. Remember, I showed you the 50-day moving average is 3% below.
We have a pullback, 5% pullback.
That happens 3 times a year on the S&P 500, all right? On average, 3 times a year. Every 16 months, we have a 10%. Now, we already had a 20% correction this year, and we had one in 22 as well. So, you know.
And my theory is the average frequency is going to just and the length is going to just increase. It's the speed at which we see them is going to just start exponentially increasing.
We were down 20%, and it took us,
what?
2 months?
2 months, yeah.
3 months maybe to get back.
Right.
On the average 20% correction that happens every 5.5 years.
Right.
It averages 335 days to get back to where you were. So, again, we want to look we look for opportunity, and when the markets did do that, we bought a ton. And you know, shoot, you can look at I encourage you to look under in Google and look at our Google reviews. I mean, they're tremendous. I'm really proud of that because we don't have shills out there. We're not telling people to shill for us. We have a bunch of Google reviews that, hey, they did great. But we bought when nobody else wanted to buy back in that April timeframe. I mean, we bought Palantir, we bought Meta, we bought Microsoft, we bought NVIDIA, we bought Taiwan Semiconductor. I could go on and on and on because these things got overdone and there was a disconnection. And I use that term a lot in our office, Nikki, because we like to take advantage of disconnections.
Yeah, we want to buy when everybody is fearful, and when everybody is greedy, like right now, we want to be fearful. I mean, when you were talking about the parabolic move to the downside, I was like, oh, our buying opportunity, because that's the way you have to change your mindset. You know, you can't think of it as a time to be scared. You have to think of, all right, now I've got cash to deploy. And when you were talking about, you know, we have a lot of profits for our clients and about how that's a bad situation to be in. Again, when we're thinking about being a contrarian, it's almost worse about new clients when they come in, because it's like, gosh, they've got cash that's just sitting there and I don't want to do anything with it because I don't want to buy in when everything's extended, because we talk about how we don't want to chase. That's the worst possible thing we could be doing.
By the way, that is rule number one. You don't want to chase anything. And when you go out there chasing the NVIDIAs and the Palantirs and the Metas of the world, I'm sorry, I'm looking for something at the right time. You don't want to. And
that's kind of the predicament that I feel like we're in right now.
We definitely are in that predicament. And I'll show you something else, which is really interesting, is that this is a really interesting graph. And what I want you to, this is over 99 years, all right, since 1926 to 2024. In that 99-year period, the market had 73 positive years. So let's say it's 73%, because we're shitload close to 100, okay? 73% of the time, it's up. However, the average over those 73, actually 100, call it 99 years, the S&P is up 10%, 10.4%. It's the average. But if you look at the 73 positive years, those years, on just the positive years, not inclusive of the down years, averages 21%. So when you have a positive year, and here's another chart. This shows you this group right here, see the cursor, that's 14 to 21%, 21 to 28, 28 up. Look at all these. These are all those big years. I would even take these years, 7 to 14. So there's only a handful of years that the market's only up 0 to 7%. And on the other side, there are 26 negative years. So really the market's up 75% of the time. We knew this. The average down year, negative year, is 13%. Okay? So what we want to try and do is, you want to have time in the market.
Not timing the market.
Time in. And this is this gives you odds. For those of you like your Hard Rock app, this is great odds. And
those of you who think that investing is betting, this is where you want you to clue in.
You actually have better odds investing in the market than you do anything else.
Because you are the house.
Yes. Now, you can't see from my big head's in the way. However, this right here, it shows you that if you were in the market, you're in the S&P 500, one day, you have a 53.4% chance of making money.
Basically a coin toss.
Right. So, fast forward 3 years. If you're in the market 3 years, you got almost an 88% chance of being ahead of the game. 10 years, you almost have 100% chance in 10 years. And the reason it's 97.5, it's because of year 2000 to 2010.
That lost decade, baby.
It didn't quite make it, all right? So, these things are really interesting.
But at least if you stuck it out for the lost decade, you ended up where you started. But if you pulled out at any point in the lost decade, you did it at most likely a low. Yeah. You never got back in until it was at a high, and you missed out.
And here's the problem, though. Not everybody has 10 years.
That's true.
If you are 70 years old, 75 years old, and you need that
retirement.
Money. Yes, if you're near there, you say, hey, I need this lump sum of money for income so that I can pay myself along with my Social Security, or if I have a pension. And that's the smart thing to do. So when you're approaching those years, you have to make sure that money is going to be more in the, I don't want to say conservative, in the more moderate, because you always have to have exposure to equities because you're going to lose out with inflation.
Or in the more risk-off bucket. And I also want to point out that it's also pertinent for people in not your approaching retirement years, for your goals that are more of a short-term horizon. If you want to buy a house in less than a year,
you don't want to risk that.
You don't want to put that balls to the wall, full equity exposure. You want to take that risk off the table. And we are existing in a time right now where fixed income is giving you an attractive yield. Take advantage of that opportunity.
I'm 61 years old, and I didn't own fixed income.
And you look damn good for your
my age, right? And I did not own fixed income on my portfolio till probably 2 years ago.
And it didn't really do anything up till 2 years ago.
Yeah, I mean, that's why I never really owned it. But now I've got things in my portfolio that are throwing off cash of 5, 6, 7, 8%. I'll take that all day long for my more conservative money.
I have it in my portfolio for things that money has a deadline of a year out.
Right. So
and I'm not 61 years old.
That's that conservative bucket.
Exactly.
And you have to have those. So what we try to do, and I'm going to get into this real quick because we have philosophies, and we use a system called the RMS strategy. And I don't know why this keeps ringing, but we have an RMS strategy, and it's called the risk mitigation strategy.
Oh, yeah.
That was great. I wanted to highlight that. I'm hitting buttons. I can't see. I need to wear my glasses, actually. So the risk mitigation strategy is something we use in almost all portfolios. I mean, almost all. And the reason for that is because we believe that there's always room to have something that will protect you on the downside. So I'd venture to say 90% of our portfolios have the RMS strategy inside it in some degree.
Why not smooth out the ride but get equity-like returns?
Yes. So
it makes sense for just about everybody's portfolio.
We just showed you that the markets were up 75% of the time, right? But 76% of the time, the markets fall between negative 20 and positive 20. That's the S&P 500. So the market go down 0 to 20%, 21% of the time. Market goes up 0 to 20%, 55% of the time. The market goes up 20% plus 15% of the time. The market goes down more than 20% of the time, only 7.5%. So we put this box here because we want to play in this box for our clients.
That's my sandbox.
That is our sandbox, all right? Not the litter box, our sandbox. And so what we try to do is if the markets go down, we don't want to go down as much. If the markets go up, we want to participate. So
we want to protect and we want to participate.
We're like the police department, want to protect and serve. And this, we're just throwing some examples up here. So we have funds that we can invest for our clients that give you upside return of 15.7. So what that means, it's a cap. That means if the market goes up 20, you're only getting 15.7. Market goes up 12, you get it all. Market goes up 30, 15.7. Market goes down 10.
Our clients, down nothing.
Break even, all right? This is a 10% buffer, so it's capped at 15.7, down 10%. This is not a current fund. It was one a year ago, but so if the market goes down 20%, you're down 10. So again, what was our first objective? We don't want to go down as much as the market. And they make these funds in different flavors. They make them in the more protection you want. So remember, 10%, you could get 15.7, but if you want 15% protection, you're going to get less on the upside, less cap. So we use these. Look, 20%, less cap. So
different flavors, different indexes, different exposure, and we ladder them as far as months. We still are able to customize a portfolio to each client's unique situation.
Yeah, we have really, really nice model portfolios that we put together, and then we customize over and above that. So it's an interesting thing, and we're fiduciaries, of course. So, our clients know us, and they refer people to us constantly, and we really appreciate you guys. But, that's why we brought you 2 weeks ago, we talked about the estate planning situation, which has really been, I know you're passionate about that, Nikki, because you found, especially in the younger demographic, that they may not have wills. They may not have, certainly don't have trust, probably.
Every demographic. I mean, 2/3 of Americans don't even have a will. It's rampant. It's led to really exciting conversations with our clients. We get to learn way more about them.
Let's not get carried away. It's not that exciting.
I think it's so exciting. We get to learn more about our clients. We get to learn more about what they love, what they want to protect, what's important to them.
Okay.
Listen, all right. So we have this philosophy that as advisors, there's multifaceted ways in which we approach our clients. But you're either a mechanic or a guide. And there are ways in which you can be with your clients. And we dip into both. But Lee is definitely more of a mechanic and a technician. And I'm definitely more of a guide.
Well, and you're a CFP.
Yeah.
So that makes sense. So we have the ability, and we have the ability in our offices now with our partnership we've just developed.
Yeah.
The ability to do trusts and wills for clients, help them get
help
that done.
Them work on their estate plans.
So we're doing that, and we have to make sure we get that done. If you have that, again, you have to be a client. We're not going to do it for outside client. It's not. It's to us. We want to do it for. It's for our. We got this partnership for our clients.
Services for clients.
Yep.
And the beauty of our team is that you can work amongst a group of advisors that offer mechanics and guides, and a lot of different services amongst that. And one of those is estate planning, and it's an incredible thing that we get to offer our clients.
All right,
and I'm overjoyed about it.
So let's talk some stocks real quick because
earnings, because it's been a hell of a week.
So this is a chart of Microsoft. So remember
that cute little company?
Remember I just mentioned a little bit ago about the 50-day moving average. So on this chart, the red line, this is a 50-day moving average. Let me put a track line. That is a 50-day moving average, that red line. So as you can see, stock goes up, pulls back, goes up, pulls back. And it comes down to some semblance. And Microsoft has a history of going through the 50-day moving average right here. Then it rallies back above, gets here, but it pretty much follows it, right? It had a rally there, pulls back, and then during the correction in April, went from $448 to $344. That's about a 20% drop. And then it's gone now from $344. It closed at $513 today. It's been extended this is a 50-day. It's extended this whole time, okay? And the company reported earnings that absolutely just crushed. And in after-hours trading, the stock here, I'm showing you. This is after-hours trading. We're here. Oh, great. I didn't know this chart had it.
That's awesome.
So it closed at 513. It's trading at $558 after hours, up $45.
Yes. If tomorrow it closes above $538, it will join NVIDIA as a $4 trillion company, the second company in the world to do so.
And let me disclose that we do own this for clients. I own it personally.
I also own it personally.
Okay, so we own this. And what do we do with it? I think I think the stock is, quite frankly, at the very least, it's a 40 PE, it's a 40 multiple. I think at the very least, it's fully valued.
Can I see the weekly so we can see the range of the
fully valued, but I think it's probably overvalued. But I mean, we are there. We are at the
end of the range.
The top, the PE ratio on the top end. And look, I know many of you may not know what a PE ratio is, but the most important thing is that we do. So,
or that you have an advisor that does.
Right. Look, I'm likely not going to sell any, but I have people up over 100% on this. So I have to think about it.
Would you trim it?
I may trim because
People
here's
are
the thing.
Up double or triple maybe in it.
So here's what you have to look at strategically, and that's what we look at. We're strategists as well. We're going to seasonally a shitty time.
Yep.
So August, September, these are all susceptible to that, all right? That doesn't mean they had a great quarter. Doesn't mean they're not going to go down. And it's extended right now.
Yes.
The 50-day moving average is like 60, 70, 80, at $485. So it's at 557. And I ask clients this. How would you feel worse if you owned it when it drops down to $485 or if it went up to 575 and you didn't own it? How would you feel worse? And so I have to address this, and I probably am going to peel some off.
Mm-hmm.
Not anything because it's detrimental. The company had a great quarter. Azure, which is their cloud services, knocked the cover off the ball. I mean,
first time that they ever reported about Azure numbers.
Yeah, it's just really, really great. I mean, everything you could see about Microsoft and has been acting. So, I mean, this was an aberration when it dropped in February, March, April. And this rally here is unprecedented. So
can you also just give kudos? Like Microsoft used to be just like the lackadaisical loser of the pack. This is a 50-year-old company. Yeah. This is not, like first to market, new kid on the block. They've had to pivot and adapt with the times, and they have crushed it.
Yeah. So here's the thing. I'm not telling you to sell any stock here.
No, none of this is advice. This is just what we're talking about, what we're going to do in our practice.
What I'm saying is I wouldn't buy it here. No way in hell. On a gap up like this, you're asking for trouble. It's already extended. Do not buy it here. No. So, but I do love the company. I love what they're doing. The cloud services obviously is working for them. They are very active in AI, and that's where the market wants to see the CapEx.
ChatGPT, they were like the first believers.
Yeah, so they're an investor. I mean, it's just great stuff. So the next main, we'll call Magnificent Seven, that reported earnings is Meta, or it used to be Facebook.
The devil reincarnate.
Yes. Now,
I also
Meta,
own it, so I'm invested in the devil.
I own that too, and we own it for clients, et cetera, et cetera. And Meta, however, is not extended. Now, here's the 50-day moving average.
It wasn't until after hours.
Look at
Who knows what happens tomorrow?
See how it follows the 50-day? It got up above it, hit a high, got to it. The correction happened, got back up, pulled back, rallied. Now we're back to the 50-day moving average. So now it closed today at $695. Here's where it's trading after hours, which I'm really happy to see that since I own it.
Ugh.
I love that. Up 11% after hours.
Oh, Zuckerberg.
This is a stock, again, I would not buy. This is a stock in the history of me owning the stock since it went public. I've sold it many times.
So much money on Meta.
I bought it and sold it. This is one I'll likely sell.
Yeah?
I may.
Out? Completely?
I may sell out. I may sell out because I think that you're I don't know how much more upside it has. I mean, at $774. At the very least, I may do some covered call strategies and do something.
Okay.
Do some kind of protection there because I'm not so sure that they can hang in there in this kind of rally. I think this is ridiculous that it's up 11% after hours.
Do you want to talk about covered call strategies right now?
Okay. I think that's too much right now since we're at the tail end of the show. We'll get into that because it's something we can do, but it's I
do think we should do a hump day just on that alone. I think that would be really good.
Okay.
Maybe.
Okay.
It's a thought.
We may.
Okay.
So let's talk about what's happening tomorrow, okay? Because we're
Yes.
almost done. Thank you guys for joining us. You guys have been awesome.
the $11 trillion, that's reporting tomorrow.
Exactly.
Just in market cap
And
alone.
So you saw charts. I showed you charts on Microsoft. I showed you Meta,
Meta.
and they look pretty good. I'm going to jump to, before I go to that one, let's go to this one.
The one that's probably going to deliver you a package tomorrow.
Always a package. Amazon. So Amazon is also a little extended. Here you go, the 50-day moving average. All right, you see that? And just show you how it relates to this 50-day. It rallies above, pulls back, 50-day, 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 goes through it. So if anybody doesn't believe me that stocks always pull back to the 50-day, well, then you're just an idiot.
Listen, trends persist. The trend is your friend.
Trends persist. So they report earnings tomorrow. And with their AWS cloud services, we'll see, because it was a really good number. Google had a decent number in that. And,
a great number.
And of course, and so did Microsoft. So is AWS going to have that big number?
Yeah. And they've been reporting, AWS has been reporting for a long time their numbers. So it'll be interesting to see.
Now, they close at $230, but look where it's trading. So it's trading up $7 after hours on the Microsoft situation, because they have their Azure exposure. So, by the way, I own Amazon. Clients own. We own a shitload of Amazon for clients. We've owned it for years, though. We are in doubles and triples in this one. So I probably won't sell this one, only because I get probably 10 packages a week from them.
Yeah.
And that's not going to stop. So, again, that's probably, I would call the core holding in the portfolio.
Because we all have a very strong conviction in it, because we're all frequent flyers, if you will.
And the fact that if I wanted batteries this afternoon, I order in the morning, they come into my doorstep.
Yeah, we're all primed, locked in.
Exactly. So now the other major company, and this is
say that we have quadruples in. You literally own it for clients at $11.11 from 2011.
We do, and I own it back in actually it's $11 and I think 92 or 82 cents. But
I've seen it for $11.11.
You did?
I have in clients' portfolios, and I love that. I think it's so freaking awesome.
I know that I have a bunch. We have a bunch below $12, and it's now trading at $209. So, but we also have people that own it in the hundreds, 110, 120. I mean, everybody's making money in the stock. Everybody that owns it, we have it.
Yeah,
but
all at a profit.
Look, it was in a nice uptrend, and then it broke the uptrend and went down, and now really hasn't been able to get going. I mean, it's gone up a little bit, but for the year, it's down significantly. I mean,
Apple's been the laggard of the Mag 7 for sure for 2025.
It's down to 250 to 210. I mean, it's down about 15% for the year to date. So it's not done well.
No.
And the whole problem with Apple is that it's been considered as the laggard in artificial intelligence.
Because you know what Apple is? They are not the first mover. You know what they do? They are not the first mover. They come in afterwards and they do it better than anybody else. They're come in
first.
and they
They're the
perfect it. Yeah, exactly.
Yeah.
That's what they've always done.
Yeah, that's what my wife's next husband's going to say.
Classic.
Wasn't the first, but he's the best.
I can't wait for the upgrade.
Yeah, she'll get an upgrade on that one. It's like a Tesla. It upgrades.
Yeah.
So, I just think that, look, I'm not going to sell Apple. We have enormous profits in it. I think at some point that they said they're going to develop a folding phone, which is already, Samsung has that.
I mean, Lee, do you want a folding phone?
I don't want one. Yeah. But some people may want one for the novelty part of it.
Sure.
And, we'll see how their services do. They're going to have probably very benign numbers in iPads and Apple Watches, because I don't see a lot of people buying more of that shit.
They also haven't had any major facelift. They haven't done anything that's
and Siri
massive.
still sucks. Siri still sucks.
Okay, I mean,
it does.
I can't even start.
She sucks.
Okay, I can't even start about the voices that you have on all of your different products.
Yes,
so,
I do have different.
I can't start there. Turn way off. Don't even get me started on your voices that you have on your Apple products.
Look, they have to upgrade Siri. If they can't upgrade Siri, that's going to be a problem. Alexa's going to kick their ass, because Alexa's not great either. Alexa's not great either.
No.
But I think it's getting better. And everybody's going to go to this. Everybody's going to go to it.
Did you see that Amazon released that they bought Bee, which is a company that has a bracelet that it's AI that wants to listen to you 24 hours a day. And from this bracelet, it wants to be able to give you a grocery list and like a to-do list and like all these reminders.
I'm not sure
like,
I want
that's
that.
creepy as
Because it could be telling me shit that I don't want to hear.
Yeah, and also recording things that I don't want it to hear.
Yeah.
Like, that's not for me. I got to walk around with just like a disclaimer at all times with like, caution, this is being recorded. Like, no thanks. That's not for me.
So, look, Apple reports tomorrow.
We'll see what happens. I'm not really concerned about it in the short term at all. They've got me so locked in their ecosystem, just like everybody else. They're going to come out with a new thing, I'm sure, in September. I heard whispers about the new
their big show. They come
iPhone
out.
17, I think it is, and that's going to be a new upgrade. So you know what? Listen.
Look, I again, I'm not sure I'd buy Apple here because I already own it. And
as an entry point for someone who doesn't own it, what do you think?
First, I wouldn't buy it before earnings, number one.
No, God, no.
I don't like to buy, just so people know this, I don't like to buy stocks before earnings, within a week or so before earnings, because it's a flip of a coin or something like Apple.
It could go either way.
It could go either way, up or down, big. And, but again, there are strategies we can use, and we will talk about that. But, if you want to talk to us about managing your portfolio or estate planning, give us a call, 407-831-8002. Again, Nikki Ward, she's a CFP. She's a rock star, and she knows her stuff. I will certainly help with the...
Lee Seiler, he's brand new to the business. Give him a call. Give him a shot.
Just been, I've been 38 years. No, but we love working with the people we love working with.
Yeah, we love our clients.
If we don't like you, I don't want to work with you. I don't need it. We don't need it, right?
It's got to be a good fit.
Right. If it's not a good fit, then we'll say go somewhere else because it's not what we want. But we want people that really are into part of our ecosystem because we want to have social events. We want to see you guys.
We want to? What do you mean we want to? We do.
I know. We do. And
we have the best.
Our clients get casino nights. They get shred days. They get all kinds of great stuff. So anyway, you guys are great. I believe we'll be back next Wednesday. I don't think I have anything going on.
I don't think so,
we're going to try and do it most Wednesdays, all right? Don't say...
regular.
You missed the Wednesday. No, we're going to do some Wednesdays, and then I'll do maybe 30 minutes of stand-up at one of these things.
Ooh.
No, I can't. It's kind of gross.
What do
My
you
stuff
mean?
is dirty.
This is stand-up.
My stuff is edgy.
Edgy.
It's edgy.
You're pushing the envelope.
You guys have been great. Thank you so much. And by the way,
see you soon.
Before it's... I can't remember which button to press now. So what I'm going to do, I think I know. I'm going to press a button, and I appreciate you guys. We'll be back next week. If you want to call us, give us a call. You can email StockDr@StockDr.com. Thank you, guys. Let's hope for Apple and
Amazon.
All right.
If not, we'll see the package on our doorstep anyways.
Exactly. See you.